Right now, this week, BlackRock is running the exact playbook that decides whether XRP ever gets a real institutional product, and it has nothing to do with XRP at all. That's the takeover code. Study it now, because when it points at XRP, you'll already know exactly what's coming. BlackRock just filed a new fund to challenge Invesco's $374 billion Nasdaq 100 product, the one that's dominated that category for decades. It didn't file to compete quietly. It filed with a lower expense ratio than the incumbent, plus a temporary fee waiver to make the cost even cheaper out of the gate. Think of an expense ratio as the annual fee a fund charges you just for holding it. A small percentage skimmed off your investment every year, whether the fund goes up or down. BlackRock's opening move is almost always the same: make it cheaper to switch than to stay. In plain terms, BlackRock doesn't try to win a new category by being better. It wins by being cheaper and bigger at the exact moment competitors can't match the discount. Here's what that actually means for you if you're watching XRP for a BlackRock signal. The signal won't be a press release. It'll be a filing with an undercut price attached, dropped the moment BlackRock decides the category is worth taking. Now, here's the receipt that proves this pattern isn't new. When BlackRock launched its Bitcoin fund, it crossed $1 billion in assets within the first week. It hit $80 billion in 374 days, the fastest any fund in history has ever reached that level. That's not luck. That's a firm that waited until demand was already proven, then used its scale to swallow the category almost instantly once it moved. Put simply, BlackRock doesn't create demand. It waits for someone else to prove demand exists, then outcompetes everyone already serving it. Most people hear market share and distribution network and assume that's just corporate talk. Don't make that mistake here. Distribution is simply how many brokerage platforms, retirement accounts, and advisor networks can put your product in front of a buyer with one click. BlackRock's distribution network is larger than almost any competitor's, which means the moment it enters a category, more buyers can access its version than any rival's version instantly. That's the second weapon, right behind price. Scale is the third. A $5.7 trillion asset manager can absorb a launch that loses money for months purely to win the category. A smaller competitor can't survive that trade. In plain terms, price, distribution, and scale together mean BlackRock doesn't need to win on quality. It wins on being unavoidable. Here's what actually gates when this playbook points at XRP specifically. We've covered this before. Insiders say BlackRock's internal threshold is roughly $3 billion in combined XRP ETF assets before a filing decision even gets considered. That threshold isn't corporate caution for its own sake. It's the same demand-proof first pattern from the Bitcoin fund, applied again. Strip away the institutional language, and here's the sequence every single time. Proof of demand first, cheap and dominant product second, category ownership third. Here's what actually happens once that threshold gets crossed, based on everything we just walked through. Scenario 1, BlackRock waits for someone else to cross the threshold, then enters with a fee waiver designed to swallow the category within weeks, exactly like the Nasdaq 100 move happening right now. Scenario 2, BlackRock skips a standalone XRP product entirely and wraps XRP exposure inside a broader multi-asset digital asset index fund instead, spreading the risk across several assets at once. Scenario 3, a competitor, the way Invesco already has with other altcoin filings, builds enough volume that BlackRock is forced to move early, before its internal number is naturally met, purely to avoid losing the category permanently. Scenario 4, BlackRock keeps building tokenization and settlement infrastructure exposure instead, treating XRP as plumbing running underneath its products rather than a product on its own. Put simply, 3 of these 4 scenarios still end with BlackRock holding real influence over XRP's institutional future. Only one of them looks like the standalone ETF headline retail keeps waiting for. Here's your structural takeaway: no hedging. Stop watching for a press release. Start watching for a filing with a price attached, because that's the actual trigger every single time BlackRock has ever entered a category. Track combined XRP ETF assets against that $3 billion figure, and track whether a competitor forces BlackRock's hand early the way Invesco is doing right now in the Nasdaq 100 space. That's the takeover code. It's not a mystery. It's a pattern. And it's running in front of you again this week, just not with XRP's name on it yet.